technology, I guess, how do you use data, and how do you want to use more data, but also how do you look at funds there are using technology. And so, without any further ado, I already introduced myself, Francesco, Roundabout Ventures, investing in deep tech. This is Anastasia, if you can pass the mic and introduce yourselves.
Yeah, I'm Anastasia, CTO at Redstone, leading the development of Sophia. That's how we call our platform. And the whole idea is to basically look at the process of VC from the value chain perspective, and then build the tools for the team that help with different tasks along the value chain.
Thanks for having me. So I'm Andre, I'm a partner with Earlybird. On the investment side, mostly focused on enterprise software, everything with modern data, dev, AI, infrastructure. And I also, like 6-7 years ago, did a PhD on machine learning and venture capital, and ever since did the tool stack for myself. Started hiring the first engineer in 2020, and by now we have a team of 7-8 engineers who build our internal platform, Eagle Eye.
Thank you. Yeah, my name is Dave. I work at Molten Ventures, or a publicly traded VC firm. I work in developing the fund of funds, so we back pre-seed, seed stage fund managers. I'm in charge of building the data infrastructure of how we capture the most amount of data and insights to go into direct investments, and also what are the companies we should be looking after that are coming from the funds, and any insights that come from it.
My name is Mike. I'm a partner at Moonfire, which is a London-based pre-seed seed stage venture capital firm that has been built from the ground up since 2020 as a machine learning-driven venture capital firm. I lead that effort at Moonfire, so my background's more from a machine learning research engineering and distributed systems engineering perspective. So we had 4 engineers and 2 investors, and we're a small team, but we are, we've been working on that for a while. It's been really good.
Hi, I'm James from Dara 5. We are a multi-family office investing in venture in the US and Europe. We back early stage funds, so pre-seed Series A as an LP, and we back companies directly from Series B and beyond. And I guess there's sort of 3 ways that data is interesting for us. One is the actual analysis of a fund when we first meet them. The second is looking at that fund and how robust their sort of OS is, particularly in sort of emerging funds, which we do a lot of. And the third is how we can use data on the co-investing side to kind of really outperform and use information as the alpha.
Cool. All right. So we've got one mic. So you guys can you all hear me? I can actually tune myself up and down. And as you heard before, it can go quite high. So amazing. So now there you go. Thank you.
So the first question, really, first, before actually I get to ask them questions, quick show of hands. How many of you are either investing in companies or launching a fund right now? So on the venture side, perfect. How many are investing in funds on the LP side? Oh, there we go. We've got a few, and so we've got actually a lot of builders. So the first question I'm gonna ask is, if you're on the builder side, what would you recommend people that? Oh, and actually, follow-on question. How many of you have actually started building some tech or using tech heavily in your process? All right, okay, so that's really perfect. So the first question is, for those that haven't, what would be your first sort of tip? If I guess they're here, they're curious about the space, what would be the first thing to potentially start with? And actually that's the same question for everybody, because I guess, and I've seen actually Molten is one of our LPs, I've seen actually how the data is becoming more and more present in how they even communicate back to us. So you want to start something data-driven, where do you start?
Maybe the simplest thing that you can do is to identify the problem as initially just asking the questions, what are the problems that I'm trying to solve, how data can help me, and then first identifying the problem and then starting from there.
Just to add to that, I would even go one step further back in terms of think before you build. What do you actually try to approach? What's your biggest bottleneck? Is it efficiency? Is it that you don't see enough relevant opportunities? Is it that you cannot convert your opportunities? Is it in the screening that you cannot narrow down the funnel? So there are many different problems across the value chain, and depending on your focus, like if you have a very specific sector focus, in a specific geography, you might have less deal flow. So your problem might be a bit deeper down in the funnel. And I feel like many people just start doing something before they actually know what they want to do. And then the question is, once you know what you want to do, you should really talk to people who have done something before. Thankfully, the venture capital ecosystem is also a bit more open in the last couple of years about this topic. So there are many people who are open and willing to share experiences, learnings, and there is a lot available off the shelf today that was not available 5-6 years ago. So some folks, including ourselves, we have built some stuff that we just replaced gradually over the years. So be very smart about make versus buy, and really think about what is the core differentiator long term. Is it that you can, whatever, scrape some data? I don't know if this is a differentiator in 5 years from now. And this is really how I think about the sequence, like think, talk to others who have done what you try to do, and then be very smart about make versus buy, like simplicity.
Yeah, I think the only thing I would add is exactly what you said. If you're not doing this now, everyone's doing the bare minimum of getting the sort of publicly available data. You will be left behind for sure. But it's also thinking, right, you have to do this today, and in 5 years' time, 10 years' time, what does your unique selling point bring you in terms of data that no one else can? Because the publicly available, everyone will do. For us, is the array of 81 different funds and what we get coming from them. That's our source of uniqueness in the data. But apart from that, it's just what else can you bring on board that no one else can have? That would be your alpha.
Yeah, I think on build versus buy, one thing I always say is like if you can buy it, it is by definition commoditized. So don't spend your like unique engineering resources building that. And keep in mind that what you can buy is a moving target. So make sure your architecture is amenable to this ecosystem continuing to develop over time. That's one like I think good thing to keep in mind. The other is if you're going to hire for this role. I think a lot of people try to hire a split like junior investor / data person. I think it's a bad move. I think the thing that's been really useful for us is hiring people who have experience building large-scale data systems and like machine learning in production, and it's easy for that demographic of people to understand the like data domain of venture capital, but it's hard for someone who understands the data domain of venture capital to become like an upskilled high-quality machine learning engineer or something like that. So like hire senior people that can like be independent over large parts of the stack, encourage them to build unique things. And keep in mind that that data domain is going to, or that product domain is going to evolve over time, and what you build needs to be amenable to that.
I might just take a slightly different approach, and I think just kind of not forgetting what you shouldn't create inefficiencies in creating data. So if we go back to the slides earlier, when we were comparing the human versus the machine, one of the things that a human's really good at is that intuition, and I just don't think that's something that we're going to put through an algorithm anytime soon, that intuition. So let's not forget that we're all working with early stage founders, we're all working and trying to invest in pre-seed seed companies, and a lot of that decision making won't be able to be done through data. Now we can obviously make sure that our decisions are as accurate as possible and utilize data to assist with that, but I don't think we should necessarily be completely replacing ourselves. Because at the end of the day, I think the deals that, particularly at the very early stages, that get done, the really, really competitive ones, they're done in a room with 3-4 people having a conversation, and the decision's kind of made there and then. They're not kind of put on the internet. There isn't data to actually tangibly have. Okay, maybe there might be some signals, someone leaving one company and starting another, but often those sort of business founding decisions have been made before any publicly available information is made online. So yeah, keep to your intuition as well as making sure that the data stuff is up to scratch.
Awesome. Right now, you've all made the mistake to come to a panel where I'm the moderator, so I started to turn it up a notch. Back in reverse, was something that you believe in, that you feel is quite controversial with what you either read online or read other people saying in the context of building tech, using tech for VC. I can see James is already going in that path of sort of like, yeah, no, don't worry, we're not going to be able to automate this all, but yeah, please choose anything you like.
I guess I'll give you an example of a couple of funds that I've been able to review. One is a very known brand in Europe, could be classified as one of the top brands in Europe investing, probably about 1 billion AUM now, I would say, and their back office data set versus a fund that we've just invested in, which was a first time fund, 40 million in size, was incredibly bad. And so I think what's quite interesting right now is small funds, earlier stage funds, emerging managers actually have an advantage over more established funds, because these established funds are 10, 15 years old. They've got partners who probably are quite stuck in their ways, quite stubborn, so to speak. You've got so much data that they've actually got to kind of retrospectively put into any new system that they're putting in. So I think there's definitely a bit of a first mover advantage, if you like, for early stage funds, small funds, emerging managers. And these incumbents, these later stage or these more developed funds are worried about this now. There's one fund that came to me last year. They've just raised a 750 million fund. I can't remember what the vintage was. And they're very much stuck in their ways on very simple things like, how do we make sure that CRMs are integrated? How do we make sure that relationships are held by one person? How do we ensure that we have a sort of transparent view on who knows who in the firm? And I think this is where the next couple of years, smaller funds, emerging funds, which if you don't know by now is what I like to talk about quite a lot, have a big advantage.
Can I jump in there? I have a slightly different perspective. I think, and I'm obviously biased, so Earlybird is 27 years in the market. But if you can overcome the friction of structuring the data, it's an incredibly valuable data asset. So talking about commodity and a unique differentiator, I think let's go back 7-8 years. Most people said, look, a data-driven approach in early stage venture is not possible. It's mostly private investors investing in a private company that don't have an obligation to disclose information compared to public companies. It's mostly qualitative data versus quantitative data. So long story short, many people said it's not possible. We all know today, in retrospect, with also large language models, transformers, and so on and so forth, we can process unstructured data and actually make sense of it, and we can semi-quantify qualitative data. So that's on the positive side. So there are methodologies to process these unstructured data and actually make sense of it. Now, if you look at the public domain of data, I think today you can still make a difference, like if you can, scrap LinkedIn at scale or get access to some other sources, you can still make a difference, but I think that's diminishing over the next couple of years as it will become more and more of a commodity. So the question is, what's left? How can you really differentiate? And I think having tens of years of proprietary internal data that is stored in a GDPR compliant way and processed so that you can merge external publicly available commodity data with very unique proprietary internal data will be the foundation to create alpha and a differentiation long term. That's my strong belief. And number two, to add to that, I think it's also, and we started that, if you initially try to screen these opportunities, most funds, they say machine learning, whatever, in reality just deterministic approaches, if headcount grows, 20% quarter over quarter, then flag this company. Now the interesting part is what happens thereafter. You recommend an opportunity to the investment professional either likes or dislikes the company, and it's very important to store these interactions with your system. And the more interaction points you have with the system, the more you can represent the very, very specific taste of your fund. So I think the more, number one, proprietary long-term historical data you have, and if you can overcome this friction, it can become a unique edge. And number two, you need to be very sensitive of storing this interaction data with your investment professionals, because that will also be the second part of creating a unique edge. So that's a bit contrary to your position. I'm wondering what you think about that.
Well, I'll definitely let the other three have a go in a second, but I do have something to just put back on there. So I think
there you go. You want it fun. This is fun, but it's fun enough.
No, that was not a roundabout.
I think that's an excellent analogy, and you're obviously one of the larger funds that are doing it well, and that's shown by the people that you're hiring and the way that you're going about it. I think the risk is almost removing the intuition from the human, because the one that's going to isn't going to flag is that one that is going to have the biggest debate at IC. Two people are going to be like, absolutely yes, this is a slam dunk. Two people are going to be like, why are you going anywhere near that? And that could be the company that actually is the outlier and hasn't necessarily been identified through, if you like, other signals that would have passed other companies. I think if you look at outliers in the history of VC, there isn't things that necessarily come up in every single company. There are things that are different every time. And so I think that's something that has to be taken into account when you're building data sets and things to make your decisions. Is not everything's going to be flagged in unison.
100% agree, and we have a lot of stuff in place to actually allow for both of them without going into further detail.
Mike, what's your controversial thing, or your contrarian view on something?
I think basically all of my opinions are relatively contrarian, but a few of them.
That's why we want you here.
I feel like a few of them that are critical are. I think a lot of people focus on sourcing. Or they think data-driven venture capital means being really good at sourcing, and I think that's just like table stakes. And the real interesting differentiation comes from, at least for us, like how do we accelerate and enhance the investor decision making in all of the modalities of decision making that they have to participate in through the investor lifecycle. And I think that one thing that is also a pretty contrarian opinion related to that is I think it's easy to talk about machines can't replace human intuition or something, but from a learning theory perspective, what does that mean? What is intuition? Kahneman would say that if you break thinking down to system 1 and system 2 thinking, intuition might be system 1 thinking, and transformers can only do system 1 thinking, and it's the planning and the more less intuitive thought that they really struggle at. So trying to identify gaps and deficiencies in data-driven infrastructure from a more fundamental perspective, and trying to just be rigorous with how you break down and decompose human decision making and reasoning critically about what are the data elements that are taken into account during this bit of decision making. Can elements of it be offloaded or what have you? I think that's I don't know. I feel like it shouldn't be relatively contrarian, but it seems like it is sometimes.
My controversial take is I think it's what you do with the data. I'm a big believer that VC should not be so behind the curtains as we are. I think sharing information, sharing data, giving everyone access to it just makes the whole market more liquid, right? That's what we want at the end of the day. The reason why we can buy and sell shares arguably today in the stock market is because everyone should have the same access to information. So I think VC will truly escalate the moment that someone says, oh, I don't want to share data. That's not alpha. Alpha for me will be in a few years' time it's no longer, oh, I know that company's revenue is X and no one else does. I think that's just a mistake. We should all know everyone's position. And the moment that we do, the alpha will not be on I have privileged information. The alpha will be I win this deal because I'm better suited for it, or I have better people skills. And what happens then? My alpha
speed of convicted decision making, accuracy of those decisions.
Exactly, but also execution of it. I have a plan for that company, and you have a different plan. And the alpha will be my plan is just better execution, or your plan ended up being better for the company, but you ended up going a different way. So I think the VC market will just get to a whole nother level if we step out of the curtains.
That's just a legislation thing. Like, as a founder, why would you give up your financial data if you didn't have to?
You're never going to be the first to do it. It's a big...
And there'll be plenty of people that want to be the last.
Yeah. But yeah, that's
You need it in Germany, you probably getting it out of the paper, signing blood in front of a notary anyway. So like, so Anastasia, what's your controversial take?
Maybe to add on top of it, it's not just about sharing the data, but also sharing the knowledge and experience. I think VCs were kind of behind the curtains or hiding what they're doing also on the data side. And now I'm seeing this trend that like community starts to open up and there is more exchange happening. Also partially thanks to the work Andre is doing here to promote this like data-driven VC, which is nice. But yeah, coming to the controversial topics, I think, so we're talking about automation, bringing efficiency, being more productive, or in general automating the things, but it's also sometimes about understanding what not to automate, what not to try to solve with overcomplicated solutions, because sometimes you can just have a very simple and dirty way of doing things that just get the job done, and then you don't need to overthink it and over-engineer.
Yeah, and we talk all the time at Moonfire about like certain processes are thinking processes and certain processes are doing processes, like writing out our investment thesis and perspective on a given topic is like a thinking process for investors. So automating the articulation of investment thesis is not something that's as valuable to do as automating the doing processes. So not only is this like, oh yeah, this is not worth spending time to automate, but some processes like the act of doing the process incorporates like further insight into the humans. And those are worth preserving for sure.
I wanted to add one quick thought on the first and the second question. So recommendation on those who are starting out and controversial. So if you talk to people who spend a couple of years building these data-driven projects and infrastructures, I think eventually culture is what will kill the success of your initiatives. And that's a learning I got from exchanging with many peers over the years. That number one is often a top-down blocker, like I don't know, the partners, general partners, whose pockets eventually will pay your initiatives, don't strongly believe into it. So it's more of a window dressing activity, where it's like, yeah, we need to do something, you put a slide into your fundraising deck and you do it, and then you have like this one freelancer or one person in the team who's like the junior investment professional who's also supposed to do something. I think that's like one big problem, and the other one is really still financial industry, and you need to change very rusty industry where most people come from the mindset that like you need to do hard work to be successful. So many people like with this classical investment banking consulting kind of mindset, like you need to hustle, and if you're not hustling, you cannot be successful in a way. And these people oftentimes don't actively want to use such new tools because it's completely different from the way they've been working in the past. And I think this top-down support from the GPs, plus also changing the culture in the firm, is really what will block most of the firms. It's not the capability to implement these initiatives, and I think that's what's actually interesting to very new funds, I think, because they oftentimes don't face these blockers similar to Mike Moonfire. I think you guys really started out with the right mindset, so you don't need to overcome it as many established funds that need to go undergo this transformation.
That's a very good point, because trying to convince a group of senior investors who have been used their entire life to say, my uniqueness is my network, I know these people for many years, then suddenly going, well, maybe devote a little bit of time to what, the data is telling you that these are great companies to see, suddenly becomes a little bit of a blocker. There's like, I'd rather spend my time in the companies that I get sent or I get to see from my network. So yeah, I completely agree.
All right, perfect. Actually, you guys have mentioned that there is not just the sources. I think we've been talking about sourcing. We've looked at previous keynote on ways to use your network. Let's also look up at the rest of the stack, because some of you have mentioned that tech is not just about sourcing. I mean, actually, for example, in our firm, for now, is no sourcing because we're so tiny that we see too many deals what we can do, but you can do other things. But I'm not going to talk about that. I'm going to let the panel talk about that. Before we talk about that, quick, really rapid fire question is almost like a yes or no. Because this is really controversial even for computer scientists, like, been of my life. So there isn't a consensus. I found something interesting. Elon recently tweeted that he's going to have AGI in a year. Concurrent to that, not the same time, but very close timing, a paper came out. Seems like some quantum effects in the brain. Now, irrespective of whether that means Penrose was right when he had his theory, very niche that not many people agree with, but does it mean that potentially we're using a system that is subpar to humans and some people are over-orchestrating on top of that and inherently basically failing at potentially trying to mimic humans? Yes or no? Are we eventually going to be able to automate everything away with machines as we get better, at least as we know today, or no? So that's a quick yes and no, and then we'll get into the other part.
What's the timeline?
10 to 20 years. Let's not say a year,
I would say rather yes than no, but then the question is, do we want to go there?
Yes and no.
That's very British.
That's very British, and it depends on your model. If you want to be a lead investor, founders want to work with people and not with algorithms. Like humans want to work with humans. If you are like a quant VC follower, then it's a clear yes, you can automate it away.
I agree with Andre. As long as companies are being built by people, you need people. But if companies getting built by AGI, then AGI can invest in that.
Yeah, I agree with Andre that I don't think you'd want to, the human interaction is an important part of the business of venture capital, but beyond that, it's current AI systems lack human cognitive capabilities in a few really glaring ways, where if you're interested in investing in AI businesses, it's a really exciting time. If you're interested in artificial intelligence as a field of study, then transformers should be really concerning to you in a few really fundamental ways. So barring really important new science, then the answer to that is vacuously no. Mike?
No, definitely not.
There we go. You see, I told you it was controversial. All right. So then on the value add, and I think that's probably, considering that we like to discuss and go back and forth, it's probably going to be towards the end. We've talked about sourcing. Let's talk about other ways. How can data help you win deals? And obviously, for LPs, it's winning deals into us as funds. And then how can you add value? And if you're a VC, of course, you're probably really trying to think of this. How can data or tech help you win deals and then potentially add value?
We're starting at the end.
Yeah,
okay.
Either way, go for it.
I guess one good example of how we're using a bit of data to help us with our investment decision. It's not it doesn't dictate the investment decision, but it supports it. We'll see. Last year we saw 450 funds. So there's and the investment team isn't the biggest. So we have we have to have a couple of ways to ensure that we can make a bit of an assessment against each fund as they come in. So we have a very simple 25 question form, if you like, type form integrated into Notion, very basic, that helps us give a league table, if you like, of the funds that are coming in. Now, if that fund scores 30%, it's likely that we're not going to take it forward, so we do support in that respect, but whether a fund scores 75% or 80% isn't going to say, okay, we'll choose the 80. It just allows us to remove, let's say, half of the funds that we have a conversation with from the table, so that we can try and spend time with the ones that in our origination that we want to progress with. Because again, maybe this is one for the more data-versed people here, but the LP-GP relationship is unbearably slow at times, and I've tried to make investment decisions quicker, but even the one that we've just done now, which I think went pretty efficiently, was 4 or 5 touch points, but it was still over 5 months. And so I don't necessarily know how we're going to be able to create efficiencies in that, but something we're trying to do on at the top of the funnel is try and cut the conversations that we're having and making that feedback very clear straight away. You're not a fit because of X, Y, Z, or we're interested in taking this forward because of ABC.
Yeah, I mean, so many people think that building data-driven decision mechanisms is about building systems to say yes to deals, whereas I think it's so much more impactful to build systems that can help you say no to as many deals as possible. So I really agree with that. With regards to winning deals, as a GP, I think obviously like sourcing early and like getting in front of founders has like obvious timing alpha, but also like being able to come. One thing that I've noticed is like a huge influencer on our ability to win deals is whether or not we can come to like a convicted decision quickly. And like founders appreciate convicted decision making, and if you just immediately align with what they're building, so like having a robust perspective on their industry such that when you meet a company, you're not like learning about what they're building in the domain that they're building in, but you're deciding whether or not these are the right founders for this opportunity and coming to a convicted decision and whatever data-driven structure you want to build to either help you build your investment thesis or come to a convicted decision quickly is one thing. And then the other thing that we do for helping us win deals is build software and technology for founders. A lot of the things that you guys are building with your vetting space of founders, portfolio companies, and investors, and building like search and recommendation infrastructure to help them either hiring talent or finding their next investors, and really taking some of the stuff that we're building for ourselves and applying that data domain towards helping our founders. And this just helps normally like, oh, who should I speak to for my next round? It's a conversation you would normally have just in person in a meeting with the founder, but giving them like self-service tools to do that. The founders appreciate that, and then it allows the founder-VC relationship to focus more critically on like things that are actually unique to the human perspective. So yeah, having like a actually differentiated portfolio support platform that's enticing is something that you can do with data that'll help you win deals, I think.
Just quickly, if I may, just on the sort of winning piece, because I think it is important from like an LP perspective to show why you're a differentiated LP. It might be a pretty LP friendly market right now in terms of like the dollars available, but that won't be forever, and so you still need to show why you win and show why you're a good fit for each other. And something that we're trying to really build out across the portfolio funds that we're investing in is a bit of a league table of our underlying portfolio companies, which helps with our double down in co-investment decision making, but it can also be very helpful for follow-on decision making for our GPs as well, because like it or not, the follow-on and like portfolio construction is where a fund can become top quartile or more, or like really flop. And so if we're able to kind of say, yes, this is a really good performing company across 10 to 12, 500 underlying portfolio companies, you can help give that GP conviction in that company if they are sometimes maybe a bit too close to it and want to back it kind of regardless, which is I think quite important at the moment, because there's a lot of sort of bridge rounds, a lot of sort of wanting a company to kind of continue, but a lot of that follow-on capital could be being deployed massively at risk and affecting the overall fund returns. And I think Dave's got a much better league table than this. I'm looking forward to hearing his.
So I'm happy to overshare here. There are two things that we're creating value add from the data. One is a very selfish one, which is Molten, and the other thing is a little bit more to the VC community. One is so on Molten, the value add that the data is providing is we're tracking 2,400 companies on the underlying portfolio quarter on quarter. What that means is that we can track basic things like implied valuation, entry points, where are they based, what do they do. But what we are now able to do is kind of track momentum, that's one. So for a few of those companies, we're able to track revenue, ARR figures, burn rate, cash balance, but also commentary from GPs that are coming from emails, that are coming from reports, that are coming from all different forms. And what we can do is being able to start tracking, okay, well, this company is pivoting. What is this company doing? What is their tech? I can now go up and source and look up any mentioning of fundraising and when that's going. So that's a pinpoint. That's what we're doing internally, and very selfish. That's where the data is going. But another thing is we've created kind of like a fund of funds newsletter back to our GPs, in which we're creating super hyper-specific deep dives into the data that they've provided us. One time I was speaking with a SoloGP who told me he didn't have a boss, and so he didn't know how well he was doing on a day-to-day basis. So what we started doing was different ways to create benchmarks and being able to tell the GPs that we've backed how they're doing, if they're doing a good job or not in terms of our TVPI averages, medians, because if you go on PitchBook, there are different ways and different things that you can, the data isn't all as up to date as possible and as correct as it should be, even though I'm a little bit biased. I used to work at PitchBook. It's probably one of the best out there, but there's still a lot of flaws. So what we're trying to do is merge what PitchBook and Cambridge Associates should be. You know, it's not fair to compare yourself to like a 300 million fund and you have a 20 million fund. So we're doing a little bit breakdowns and being able to share back with the ecosystem kind of how different strategies, how different performances are going.
You asked about focus across different areas than sourcing within the value chain. So first of all, it's important to have like the same framework in mind. If you talk about the investment value chain, it's like sourcing, screening, due diligence, portfolio value creation, and then exit. You need to return the money. So that part of the investment process, not to talk about back office, fundraising, and so on. And I think it's pretty clear there are studies out there showing that 2/3 of the value creation in early stage venture capital is in sourcing and screening. So it's really finding and picking the winner's game. This is why most funds actually start there, in addition to what I said very early of this panel, that you need to look on your individual bottlenecks. Now, we also started on sourcing screening, but I think to your specific question, two examples on where we focus and how it can make a difference. Number one is really on the due diligence part. So it's very important to create a single source of truth and very efficiently allow the investment professional to prepare for meetings and get into the founder meetings, convince the founders from the first place. Because eventually it doesn't make a difference if you end up finding the company at the right point in time, you screen them, you narrow it down, you get in your IC to the conviction you want to invest, but then it flips around. You need to convince the founders to actually work with you. So we talk to many founders and we see that for them it's very important from the first impression and even before that. So it's very important that the founders have heard about you already, be that your firm brand, your personal brand, in terms of like what do you stand for, is there content out there? So they might research you, they might look into your track record, portfolio, and so on and so forth. So it's very important to start there. And if you get into the first meeting with the founder, to really confirm this impression they got from you online. So for us, it's very important that everyone from our team who gets into first meetings with founders is incredibly well prepared. And that means we set up our systems so that they can, like we have an automatic competitive landscape mapping so that you know already, like, I don't know, Check24 comparison. These are the competitors, this is how much they have raised, this is how they differentiate. I don't know, in platforms like Tigos, we have references linked here, those are the 3 pros, those are the 3 cons. So you get into the meeting, in 5 minutes you're well prepared. This is very important to us and we can see it makes a difference in the win rate post-term sheet. And the second one is touching upon what Mike said earlier on the portfolio value creation. On portfolio value creation, we thought a lot about like how do we actually create value. So we looked into, for example, customer introductions to co-investors, introductions to follow-on investors, recruiting support. So we took these different building blocks and then with the stuff that we have built in building blocks for the sourcing piece already. So we scrape many people. If you scrape people, you can already build like a LinkedIn recruiter on steroids, which matches the portfolio companies. So this is stuff we've built. We help them to map their competitors because we have built this part already for our screening and due diligence part. So the question for me is rather like, what are the building blocks and what are actually the use cases you want to apply them? Because a lot that you have built for the sourcing and screening, you can reuse for portfolio value creation. And this is what Mike said, it's just about the interface. Like you need to have an interface to the founders to actually make sense of the data. And we started with sourcing screening, went a lot into due diligence in the past year, and now build or reuse these components for portfolio value creation a lot.
Cool.
Actually, I think pretty much everything has been said, and we're working in the similar direction. So it's about identification of the companies early on, identification of the deals, and then you need to be prepared and for the discussions and for the due diligence, and for that data can be used in multiple ways so that you're just better prepared for the discussions, for the process, and the team can be more efficient in the process of analysis of the company. And then when it comes to the value creation, it's basically about those things that are already out there for deal sourcing. So we have also the competitors search functionality that we can then quickly provide an analysis to our portfolio company in terms of how their competitor landscape looks like, doing the analysis of the relevant follow-on portfolio or follow-on investors, but also connecting that to the networks data so that the introductions can be done. So I think these are the parts of the value chain that can help with winning the deals.
Awesome, right. Thank you so much for joining the panel. You guys probably after a keynote and the panel have lots of questions. We're going to have an expert sessions interactive just after the break, so lots of questions there. So for now, just a quick break, and thank you all so much. Please, a big round of applause.